What's up, everybody? Welcome back to the channel. Today, Christy and I are taking it back to the basics of the infinite banking concept. We're gonna go back into why we do this, how it works, and why it's so important to revisit the fundamentals, because understanding them is key to breaking free from the traditional banking system, and we are all slaves to that. So if you haven't already, make sure to hit the subscribe button, smash that little bell so you never miss a new video. All right, let's dive in. Here's everything you need to know about the basics of the infinite banking concepts.
This infinite banking process has really got me intrigued and excited. And so once again, we have Chris Naugle on the channel. Thank you for joining us today, Chris.
Pleasure. I thought we would just kind of go back to the fundamentals, kind of like, Michael Jordan's coach always talked about how Michael would step on the court, best basketball player of all times. And every time when he got on that court, he went back to the fundamentals, the basics. So I was thinking, let's talk IBC 101, the fundamentals.
Absolutely. And the reason being, a lot of people have never heard of this before. So it kind of takes a few, videos and times talking about it so that it clears up the confusion. So have at it. I'm excited to go through it for sure.
So basically what I was thinking of doing today, folks, I want to kind of point out what you're going to learn. We're going to just talk about what you've been taught to do with your money. Specifically, your guaranteed money, your bank account money, and how and why we do what we do. And then we're going to take that and I'm going to show you how just changing one thing, and that is where your savings goes first, and then adding one step to that, how it can completely change your entire financial future. Not can, it will. I think that's important to specify because, a lot of people are like, well, if I earn this return or I get that in investments or this, there's always these caveats, these what ifs. In this system, which is called the infinite banking concepts, there is no what ifs. It is just guaranteed. It will work 100% of the time as long as the person using it, you, me, and everybody else, follows the process. And the process is incredibly simple. So let's dive in. I'm going to go to the whiteboard and let's just talk about how we have been taught to do things, right? We've been taught to go out and make money. We go out and we work and we make money. And then that money, one way or the other, today it's mostly direct deposit, but back in the day, you remember you used to take your cash and deposit it in the bank. Then you'd take your paycheck and you deposit it into the bank. So let's just kind of look at that. This is your deposit. So once the money goes into the bank, some of you, and I know there's a lot of you, go out there and you try to find the best interest rate you can. You search all the banks, you go online looking for the highest interest rate you can, and you find that interest rate. Now, what I can tell you is if I were to look at savings accounts and I were to go back 10 years and look what was the average interest rate earned on savings accounts, what would you all think that would be? Put it down in the comments. What would you think that interest rate would be over a 10-year period of time? It's probably not what you think because it was 0.43%. But I know some of you are doing way better than that because today in this high interest rate environment, it's not uncommon to have people getting 3 to 4%, right? Some of you have accounts that you have found for 3 to 4%. But let's kind of go through what happens. The money sits in that bank account. You feel good about it. You've been taught to build an emergency fund, right? In case something tragic happens, your main water line breaks, you're getting a car accident, all of that. Now that emergency fund for everybody's different. The common is usually 3 to 6 months of expenses. So you got that taken care of. Then some of you have exceeded that and you have gone out and you have used banks to buy CDs, certificates of deposit. Why? Well, because you get a higher interest rate, or you've just played today the high yield savings account. HYSA is commonly what it's called to find the highest rate, which is how you're getting to this 3 to 4%. But let me just ask all of you, what are you giving up for doing this? First off, when you put the money in the bank, let's just kind of get rid of this stuff here because I think we all agree that that's how the banks work. And let's go with the higher number, 4%. Let's say you're earning 4% on your savings account. That's a good rate of return. Matter of fact, today that is beating inflation. But back a couple of years ago when inflation was upward of 8 to 9%, how much were you getting on that account? Because I can tell you right now, it was not 4%. You're getting a lot less. Some of you are getting 0% in your savings. So I think the thing I'm trying to make the point of is this 4% is not guaranteed. Okay. That changes almost with the wind. It's pretty windy out here today. And if the Fed came on and said, hey, we're dropping interest rates today, guess what happens to your awesome 4%? That's right. So I'm just going to write an arrow. It goes up or down with whatever the Fed decides the rates are going to be. So you don't really have any kind of guarantee. Oh, sorry, I did forget about one. FDIC. Yes, the FDIC guarantees your account up to $250,000. But what happens when you have more than $250,000 in the bank? You shouldn't. You should find another bank, another account, open up multiple accounts, but that creates more work for you. But we at least know it's guaranteed. So now let's kind of go to the second side. And I'm going to change up the color here because I want to kind of really walk you through what we've been taught to do. So you've got this money in the bank. Let's just say somebody's got $25,000 in a high yield savings earning 4%. That's going to be our case study person. But now all of a sudden you want to buy a car and that car is $25,000. Okay, so we're just going to use a $25,000 automobile, which those puppies are hard to find today. It's very difficult to find any car for 25 grand, but let's just pretend. So you got 25 grand in the bank earning 4%, and you need a new car. So one of two things are going to happen. Number one, you're going to take a withdrawal from the bank, and you're going to pay cash for the car. Now, that's great, right? Because you have no monthly payments for that car. You're driving the vehicle, but will the car be worth more or less next year, the year after? How about the year after that? How about every single year? Is your car worth more or less? If any of you said more, please tell me what kind of cars you're buying, because every car I know about goes down in value. So your car is going to be worth less than $25,000 in time. And the other thing that happened is when you took the withdrawal from the bank, your account went to zero, which means you're no longer making interest on that money. So it's an opportunity lost. You lost the earning potential of $25,000 to buy a vehicle, which the earning potential of that vehicle has to go down because it depreciates. Just trying to call out what's happening here. But hold on, that's not your only option. Many of you would actually do what the majority of people do statistically, is they would leave their $25,000 in the bank earning 4%, and they would go to the bank and they would petition them to give them a loan to buy the car. Okay, so now the bank, now let me come over here because the bank is not you and the bank is not there for your convenience, for your benefit, and for your growth. The bank is there for their growth, their profits, and to increase their stock for their stockholders. Let's be very clear about that. So you took a loan from the bank. How much could you get a loan today for a car? Well, if you go online, I use bankrate.com. Right now, the rates are anywhere between 6 and 7%. So let's just talk about that. The bank is paying you 4 on the $25,000 you have there, but the bank is charging you 6 or 7. So what are they making in between? They're making a spread. The difference between what they're paying you and what they're charging you. But hold on. Remember, I said every time the Fed sneezes and makes a move with interest rates, this rate can go down or up. But what happens to the loan? Does the rate ever change? If you lock in a car loan at 7% and you're at 4%, does this loan ever change over the course of that duration? 5, 7 years, whatever your car loan is? No, it stays 7. But this almost guaranteed will change. And I can tell you right now, we're on a downward trajectory of interest rates. So the chance of this going up, well, not so good. So one is going down, the other one is staying the same, and you're still buying a depreciating vehicle that is going to lose value. So in this proposition, you are going to be required to make principal and interest payments back to the bank. So on a $25,000 car, I'm just going to make this up, but let's just say it's $500. You're making $500 payments back to the traditional bank. I know some of you are like, get to the point. I'm going to, and I'm going to promise you, you're going to love the point when I make it. So your principal and interest payments are $500 back to the bank. Do you get any of that money? You do not. All $500 of that monthly payment you make go back to the bank. None of it ends up in your account. But hold on, you're still making 4% on your 25 grand. And then at the end of the year, the bank will conveniently send you a 1099 and you will pay tax on that 4%. I almost forgot I left that out. I was trying to save the best for last. Yeah, that measly 4% or whatever you earn, they're going to charge you tax on that. So that's your options for buying a car and a house. Most of you are going to take out a mortgage. It's going to be the same thing. So who wins in this transaction, Christy? Who do you think wins here? Is it the person with the bank account?
Obviously the bank.
The bank always wins. But that's what banks are in the business of doing. The banks are in the business of controlling your money, using your money to lend it out, to make a spread, and they are always going to win because that's what they're set up to do. So now let's just go through and let's just change the dynamic here, okay? Let's go through and let me show you exactly what the wealthiest families in history have done. And let's keep all the numbers identical, okay? $500 monthly payment on the car. Over here, we're going to just kind of get these things away. What if all you did, folks, is you applied this concept that Christy mentioned called the infinite banking concepts? What if you applied that in your life? What would it involve? Well, I had mentioned it's going to involve changing where your savings goes first. That's the one change. So what we're going to do is we're not going to make those deposits into the traditional bank. Now, you're still going to keep some money at the traditional bank, but why keep $25,000 there? Maybe you figure out that you need $8,000 in the bank. Whatever your number is, you're going to keep that in the bank account, okay? But then you're going to take the savings that you would normally have put in the bank and you're going to change where those savings go. And we are going to start to create our own banking system. I always say BYOB, be your own bank. Now, this banking system, and I'm going to tell you what it is in a second, pays you a guaranteed interest rate that never changes for your entire life. So if the bank was paying you 4%, but that changes, and the average for the banks are 4.3% over 10 years, what if you could get a guaranteed interest rate? And I'm just going to pick on one of the companies that we're going to talk about in a second, paid you 3.25%, guaranteed in your contract. And it never changed as long as you live. Is that better than what the bank is giving you? Yes. But hold on, there's more. What if that place where you put your savings, what if they paid you a dividend every single year? Now, this is not guaranteed, but they've never missed one. They've paid dividends consecutively for well over 100 years, never missed a single one, not through the Great Depression, not through the Great Recession, none of them. With the guaranteed interest and the dividend, they call this the dividend crediting rate. You right now, oh, what happened? My board froze. There we go. What if now the dividend crediting rate, okay, which is the guaranteed interest rate plus the dividend, was 5.75%? That's better than 4%, right? And 3.25% of that never changes. And the dividends actually have been going up when interest rates have been going down. It's funny how that works. So now let's keep going. This place where you changed and put your money, let's talk about some of the other features. Now your money, let's just call that the $25,000, okay? Your money is guaranteed to grow. Your money is going to grow tax-free. Now, remember over here, I said that the bank sends you a 1099, but over here in this account, it is going to grow tax-free. It is also going to be 100% private, which means it is not reported to anyone except for you. Your bank account is reported to every single person out there that wants your bank account information. But this account, oh, no, it's protected. It's private. But not only is it private, it is protected. I actually kind of let the cat out of the bag. It's protected against judgments and liens in almost all states. You can look that up on Google, but these accounts are protected. Last thing, because already, folks, where would you want your money? In the bank account? Or would you want your money in this account that I'm talking about, which I'll tell you what it is in just a second? I think all of you are agreeing this seems like a much more logical place to put money. But let me kind of bring it all home one more time, not the tax-free or anything else in the 5.75%. Who cares about all that? Now, what if when you died, this account paid a tax-free legacy to your family? Now, let me ask you this. If your bank account had 25 grand in it and you died the next day, how much do your beneficiaries get? 25 grand, right? Minus probate. In this account, let's just hypothetically say you had 25 grand in it. This account could pay you hundreds of thousands of dollars upon your death to your beneficiaries tax-free, no probate. So now there's a legacy included. So I think when we wrap it all up, you can see that most folks logically would say that this is where you want to put your money, right? So what is this account? This is where I always confuse people, or I guess get people, a little like wondering that's not true. This account that we're going to talk about is nothing more than a mutually owned life insurance company. And we're going to take out a specially designed, let me repeat that, specially designed and engineered whole life insurance policy. Yep. Or put a comment down there. What do you think about that? This is nothing more than a specially designed whole life insurance policy from a mutually owned life insurance company that pays dividends. What have you been told about whole life? Well, if you've been following the gurus like Mr. Dave and Susie, then you probably said that's the worst place you can ever put your money. But we just went through the facts and you all said that seems like a much better place. But now all of a sudden, because some guru told you that that's not the better place to put your money. Well, based on the facts, the contractual facts, you all said it was. That's what this is, specially designed whole life. Now, let's go over and let's do the same thing we were going to do before from your bank account. We're going to buy a car or a house, but we're going to just talk about the car. So remember, we said the rules of engagement, you got $25,000 in cash value because you made deposits into this policy. You got 25 grand in cash value. And let's just hypothetically say you got a $500,000 death benefit because we're going to need that here. Okay. Now we're going to basically buy a car. How could we buy the car? Well, just like the bank, we could take a loan. We could take a loan from our policy. And that loan right now, the interest rates are about 5.25%, give or take, a little bit. And over here, this insurance company that I was talking about pays 5.75%. So if you're making 5.75 dividend crediting rate and it's costing you 5.25, what are you making? Although it's not very big, we're going to cover that in a second, you are making a spread because you are taking back the banking functions in your life. So you're making the spread, 575 minus 525. Perfect. Now, if you buy the car with that 25 grand, what would you do? Well, when you were going to borrow from the traditional bank, you were going to make payments back to the traditional bank. So you're going to do the same thing. So we're going to make a $500 payment back to the policy. Because you would have done this if you financed the car through the traditional bank. This is nothing different. Same exact payment. All the things are the same, except for whose name you write on the check. Before you wrote XYZ Bank. Now you're going to write your name on there because you're going to deposit the money back into your account, this whole life policy. How much money's in the account when you pay $500 back to your policy? Anyone? Christy, how much money would be back in the account?
The same that you deposited initially, and then you get, that's what's amazing. I'm sorry, I have to stop you. That you are paying yourself back and that's available to you again within 30 days.
Yep.
That's amazing.
Absolutely. So we got two components here. Christy, you were kind of mentioning that the deposit that you put in, and I ran over that, but that's important. Let's just say somebody took $30,000 and put it into the policy. They would have access to roughly 90% of that $30,000 immediately in the first 30 days. So most people, when they think about whole life, they think, oh, I'm not going to be able to take my money for 1, 2, 3 years. That is not the case because it is specially designed and engineered to be high early cash value. That's how we design the policies. So because we're doing that, you have immediate liquidity of your money in the first 30 days. But what we were talking about then is the payment that you would have made to the car. Remember when you made the payment on your car, and all of you probably have had car payments or do now, when you make that car payment every month, that money doesn't show back up in your bank account, does it? No, it goes to the bank. The bank profits from that, not you. But because you are now becoming the bank, because you changed where your money goes first, and now we're applying this process. We're taking loans from our bank, just like you would take a loan from their bank. We're basically structuring the loan identical to what the loan would have been with the traditional bank. I just used the $500 for the $25,000 car, and then we're making payments. Okay, we're going to call these loan payments because that's why call it anything other than what it is. It is a loan payment, but it's a loan payment back to your policy, which is your banking system. So therefore, $500 every month is accessible to you. That $500 becomes available on top of any additional payments or premium deposits, as we like to call them, that you're putting in. You see, what you just did is you took back control of your money. But hold on. There's one more thing that I didn't tell you. The 25 grand, or let's call it 30 grand in this case, because I want to be fair. If you put 30 grand into the account, into the whole life policy, and you took 25 of that 30 grand out to buy the car, how much money is left in your policy?
30.
Yeah, if any of you said 30, you're right. Because that 30 never left your account because you took a loan. But whose money did you use? Whose loan did you like? Who gave you the money for that loan? The insurance company. And what they basically do is they give you the $25,000 that you take out in this example. They give you $25,000 of your death benefit because they got to pay that death benefit when you die, but they never said you can't use that death benefit while you're living. Now, let me preface that. You can only use up to the amount of cash value. So if you got $30,000 in cash value, the insurance company will only allow you to use up to $30,000 of your death benefit because they are going to collateralize. They're not dumb, just like banks aren't dumb. Banks want collateral for all the loans they make. Well, so do the insurance companies, except for the collateral for the insurance company is the cash value in your policy. So because you're taking the 25 grand from your death benefit, your money, your 30 grand still stays in your account, earning uninterrupted compounding interest. Wow, you went out there and you bought the car. Wow, you made a spread on the first round, but you also are making money because this $500, remember, from the bank was principal and interest. So the interest here that you're earning, the interest that would have been charged on the car loan, that's all going back to you. The only thing you're losing is the 5.25. And a lot of times you can go what you're earning on your policy minus the loan, or what some people like to do, because it's easier, is they come over here and they say, okay, if the car loan was 7%, they do basically, this is the spread that they do. This is how I do it. So I would say if the bank was going to charge me 7% on a loan for a car, I'm just going to take, and I'm going to do the same amount the bank would charge me, 7, and I'm going to subtract that from the 5.25% the insurance company is going to charge me, and that's my spread. But you see, the one thing we're not doing, if I stopped right there, you're already like, okay, well, that's good because I'm making money here, and I'm still making all the interest and dividends on my money in the cash value. So you already would say you're winning, but you see, you're winning even more because you're being the bank. Now, pay attention. This is the final thing, and then I'll stop. This is vital. When you take a loan from a traditional bank, you are making payments to that traditional bank, principal and interest. But that principal and interest is reducing the balance on the loan, which you are benefiting you're not benefiting at all. You're just trying to get out of debt. Here, when you are the bank, when you do this and you make $500 payments, let's just do the math, and you can all do this with me. Remember, we took a $25,000 loan, and that loan came from the insurance company giving me part of the death benefit. Therefore, if I die the next day, my family gets the death benefit minus the outstanding loan. I want you to be clear about that, okay? They collateralize that loan with the cash value. So every month, you're making payments. We call these loan repayments back to your policy. I like to call them recycle, recapture, but back to your policy. Every payment is $500, and that's monthly. So let's just kind of round up. Let's do yearly, $6,000. So each year, you're going to repay the loan to the insurance company to the tune of $6,000, which now, after 1 year, the insurance company is charging you 5.25% on a declining balance. 5.25% of 19,000 is less than 5.25% of 25,000. So not only are you keeping all of your payments that you're making on the car, not only is it building your cash value and your cash value is still compounding uninterrupted, but now you're actually making more money because what they call an APR, your APR that you're paying the bank, your bank, the insurance company, is going down. So every single payment you make back to the policy gives you more money, but also allows you to pay less to the insurance company. Hopefully that made sense. Christy teaches this all the time with the HELOCs. So when we're paying a loan down, we're paying less interest to the insurance company, but we're losing no control of our money. We're not leaking any money. This is how you become your own bank. Now, I did it for a car, but what else does it work for? Well, you could use this to pay down debt. You could use this to buy real estate. You could use this to lend on real estate. You could use this for anything. Hence why it's called the infinite banking concepts. Folks, it is so simple. Again, it involves you changing one thing, where your money goes first, your savings specifically. You're never going to not keep money in a bank. I'm talking about the savings that you were putting in the bank. You're going to change where that goes. And then you're going to add one step. And this was the step. You're going to create a circle so that all the money that starts in your banking system comes back to your banking system by doing exactly what you're doing right now. You're just writing checks to the wrong bank.
That is absolutely amazing. And I'm going to point out a couple of things that come to my mind while you were talking. One, you're talking about over $5,500 in interest being paid to that bank for that car loan. Okay. Mm-hmm. So that's a 6-year loan, 5,500 plus. I mean, that is just math that you are going to make a killing off of paying yourself back. Okay.
That's a lot of money.
That's a lot of money.
I'm glad you did that. You did the math on the back, and you ran a calculator. So like if people finance cars every single day and they think nothing of it, but like just this little car, this $25,000 car, you'd give the bank $5,500. That money will never come back to you. It's gone forever. And your car is going to lose value too. Thank you for doing that.
And let's don't forget that interest is front loaded towards the front, right? So, I mean, we could sit here and talk all day about how the banks are kicking our butts. But when you do this math on how the whole life works, there's nothing, I mean, that to me has become a greater asset to me than learning about velocity banking. Because I'll give you an example. I had a client just this week. They had $173,000 sitting in their checking and savings account. Okay. And they had credit cards galore. And I showed them how paying off just $5,000, if they put it into a whole life first, turn around, pull that out, pay that credit card off, it was 29% interest that they're throwing away. They're literally, people are not aware that they're throwing away money that they don't have to be throwing away. And, I talk about this every single day. I post videos, I go do lives. I'm just trying to get the information out because people don't realize that they're not just making payments, that they are throwing away their money and they can stop it. So this right here, I mean, again, 5,000, 10,000, 25,000, 100,000, whatever people have to put into it, even if you have to start monthly. We have people that I had a question this morning. Hey, I'm 50 years old. How much would I have to put in to start this policy? And I talk about doing the chunks from the lines of credit because that's exactly the way I handle mine. I just, whatever the premium is for the annual amount there, I throw it in. I'm done. And now I'm letting my income come in and pay that amount back off in the HELOC or the line of credit.
It's the same principles that you teach. Literally is. It's just using a different vehicle and just a different process. That's all.
And you also say that for someone's age times 10 is what that monthly payment should be, right?
Yeah, let me just kind of do that. So, people ask all the time, what's the minimum amount that they can put into one of these specially designed whole lives so that it works for this banking system? Well, it's simple. I'm just going to use me. I'm 46 years old. 10 times my age is simple. You just add a 0 to my age. So 460 would be the minimum monthly amount I could use to start this. If I put less in, which you certainly could do a policy for less, it's just not going to be effective like what we normally teach. So I kind of draw the line at 10 times age. But again, other agents might say, oh, that's not true. It's not the minimum. There's no standardized minimum. And they're right. But you know what? When I set people up with their banking system, I want to set them up to win. If I do any less than this, I know what it's doing from the design of the policy, and I am not setting you up to win. I'm literally setting you up to kind of barely get by. And I'm not trying to create an extra payment for people. I'm trying to create a banking system so you're making deposits. So that's why we come up with the minimums.
Okay, so I want to add to that again, because this is the way I would teach somebody to do that. If you have a line of credit, okay, and most people have something out there, credit cards all the way to HELOCs. The 460 times 12 is $5,520, right? So if you have $5,520 that you want to pay into this whole life policy, and you take this amount out of a line of credit, transfer it over into a whole life policy, what does that mean for paying it back off in the line? Well, isn't the average American income about $5,400 right now? Check this out. What if you made 5,400 throughout 1 month and you put it back into this line? How much interest are you going to pay on that? Very, very little. Second month, it's paid off. So the point is, you can do your chunks. Start those policies. They start growing at compound interest while you're doing nothing but letting your income go back in and work this back down. Do you see now how quickly I have moved into almost 6 whole life policies with Chris Naugle's team just by using my line of credit? So I'm telling you, there's no excuses. That's what I'm saying. There's no excuses for you to be in debt once you figure out how the process works. Once you figure out how to use velocity banking, it's a game changer for finances. And I am super excited that I'm sharing what I am. I'm excited that you are taking the time to come on here and explain this to us, because, I tell people now, I've been working with Chris Naugle every week, and he's training me through these videos what's going on with those infinite policies. And and when I say I'm excited about this, this is my new high. This is my adrenaline rush. So thank you so much for doing what you do.
Oh, it's my pleasure. And hopefully it was simple enough for everybody, because this is basic fundamentals, folks. Just like I mentioned earlier with Michael Jordan, his fundamentals were footwork, dribbling, just basics. These are the basics. You can get more advanced as you go on, but you always want to start with the first step. And that is changing one thing, where your money goes first. And then number 2, taking back the banking functions in your life, which is change the process on how you use money. It's the same thing you're doing now. You're just doing it and writing the check back to yourself instead of their bank. Thanks, Christy.
That is such great information. Guys, I'm doing this myself. I always tell you all that if I haven't done it and played with it, that I'm not going to present it to you. And I'm telling you, you have got to try this out. I've only had the policies with Chris's team for a little over 2 years, and I'm already seeing the benefits of having these policies. I've already used them to take loans and put it back. I mean, I'm amazed, and I just want you guys to understand that there is a way to excellent financial peace, not just getting out of debt, but growing your wealth and a legacy for your children.